When you look at a massive multi-billion-dollar company, it can feel, well, pretty overwhelming. They're all over the globe, they offer a ton of complex services, and their financial reports are endless. Today, we're going to cut right through all that noise. We're going to put the tech giant Cognizant to the test using a really simple, structured checkup. So that's the big question, right? How do you actually do it? How do you take a company with like 350,000 employees and billions in revenue and get a clear picture of its health? It seems like a huge task, but it's totally doable if you've got the right framework. And here's how we're going to do it. We're calling it the 4-point checkup. It's designed to be super straightforward, but also really powerful. First, we'll do a business check to figure out what they actually do and if they have a real edge. Then the management check. Who's running the show and are they being smart with the company's money? After that, we'll do a financial check. Look under the hood at the numbers. And finally, we'll pull it all together for the verdict. Let's get into it. Okay, first up, the business check. The goal here is pretty simple. We want to understand the business and see if it has what investors call a moat. A real durable competitive advantage that keeps the competition at bay. I always think the best place to start is with how a company talks about itself. Cognizant says its purpose is to engineer modern businesses to improve everyday life, and their vision, to be the preeminent technology services provider for the biggest companies in the world. Now, this isn't just corporate jargon. It tells you right away they're focused on high-end, big-money clients. So what does engineering modern business actually mean? Well, it breaks down into these key areas. You can see there's a huge focus on all the stuff you hear about today: AI, the cloud, Internet of Things. They also handle giant operational tasks, something called business process outsourcing. Basically, they want to be the one-stop shop for a huge company looking to upgrade its entire operation. Okay, so what about that moat? On one hand, Cognizant has its reputation, its AI skills, and its global scale. Those are real strengths. But look at the other side. Look at that list of competitors. We're talking about absolute titans: Accenture, IBM, Deloitte. This tells you everything. Cognizant is a huge player, for sure, but it's not like they have an impenetrable fortress. They are in a street fight with other giants every single day. So we've got a solid business, but it's in a super competitive space. That leads us right into our second point, the management check. Because in a tough industry like this, the decisions that leadership makes about where to put the company's money, its capital, are absolutely crucial. And this slide really lays out their strategy perfectly. Management has a very simple, clear framework for how they use their cash. They split it right down the middle, 50-50. Half goes to growing the company by buying other companies, and the other half goes right back to the owners, the shareholders, through dividends and stock buybacks. This is a big signal of a disciplined management team that's balancing growth for the future with rewards for today. And you can hear this strategy straight from the top. The CEO, Ravi Kumar S., isn't just trying to hold steady. He's talking about a builder mindset, which is all about going after that huge, wide-open AI market. This isn't just about using other people's tech. It's about creating their own new solutions and grabbing a much bigger piece of the pie. It's a bold vision, and it fits perfectly with that acquisition strategy we just saw. Now, a great story from the CEO is one thing, but the numbers, well, they have to back it up. So let's move on to our third section, the financial check, and see what the company's report card really looks like. We're going to zero in on 3 key metrics. First up is return on equity, or ROE. This is a huge one for profitability. It tells us how much profit the company squeezes out of every single dollar that shareholders have put into it. And at over 17%, that is a really strong number, way above average for a big company. It's our first big clue that management is using money effectively to make more money. Next, let's look at the operating margin. Just think of this as the pure profitability of the company's main business. For every dollar in sales they bring in, after paying for all the day-to-day stuff, Cognizant gets to keep about 16 cents as profit. A margin like that is super healthy and consistent, and it's this profit engine that fuels that 50-50 cash plan we talked about. And finally, debt. The debt-to-equity ratio is just 0.04. That is incredibly low. I mean, it's basically nothing. It means the company is paying its bills with the money it earns, not by borrowing. That gives them a rock-solid balance sheet and means they can handle tough economic times without breaking a sweat. So you put these 3 numbers together, it paints a picture of a very financially healthy company. But let's add a little bit of context here. This timeline shows that operating margin over the past decade. You can see it was cruising along at a high level, then it took a pretty big dip around 2020. But since then, it's been on a steady climb back up. This shows more than just a single snapshot of good health. It shows a history of performing well and, importantly, the ability to recover from a hit and get back on track.
Okay, so let's recap real quick. We've got a solid business in a tough, competitive industry. We've got rational managers with a clear plan, and we have strong, improving financials. So, this all sounds like a home run, right? Well, this is where we get to our final section, the verdict. And this is where we compare how the company's doing with how the stock is doing.
And this is where the story gets complicated. Let's say you invested $100 in Cognizant at the end of 2020. 5 years later, you'd have about $109. Now that same $100 in the general stock market, the S&P 500, would have almost doubled to $196. And in the tech part of the market, it would have exploded to over $258. So despite all those solid fundamentals we just went through, the stock has dramatically underperformed the market. This huge gap between how the business is doing and how the stock is doing brings us to a really crucial investing principle. Because the ultimate test isn't just what a company did in the past, right? It's about what it's going to do in the future. And if you can't build a strong, confident case for what's going to happen over the next 5 years, it's often smartest to just move on. So, our checkup is done. We've seen a financially sound, well-run company that's holding its own in a brutally tough industry. And yet, the stock market just hasn't rewarded it. And that leaves us with the ultimate question for any investor. Is this a red flag for hidden problems? Or is this a classic case of a solid, valuable company that everyone is just overlooking right now? Based on this checkup, that final verdict, well, it's yours to make.